Index Universal Life is one of the most profitable products that life insurance companies can sell. Now, over the past couple years on my channel, I've been making it a point to try to show a lot of the holes that Index Universal Life has and why ultimately life insurance companies shifted from focusing on whole life products and guaranteed products to products like Index Universal Life. In this video, I'm going to cover why and how I built that hypothesis and ultimately what it means for you as either somebody selling life insurance, Index Universal Life specifically, or somebody who's contemplating buying a policy, an Index Universal Life policy, because you got to know this stuff. You got to know the history. I'm a big believer. We need to understand the history so we can understand the future. And so I'm going to get into this. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Can't wait to see you in there. Hey, what's up, Cashflow hackers? It's Chris, Life 180. In this video, we're going to be going through how life insurance companies built the Index Universal Life space. There is a situation right now, there's a lot of conversations with a lot of influencers on TikTok and Instagram and YouTube talking about how there are 70 companies-ish that are selling Index Universal Life, talking about how good the product is, how much upside potential there is, and all this different stuff. But the bottom line is that's why I created the IUL challenge, because these policies haven't performed up to the conservative illustrated rates, even in the greatest bull run of all time. But in this video, I think it's important to really understand, if I'm gonna put my money into anything, I need to understand what I'm putting it into. I really need to understand that product. And in order to understand the product, you need to understand the history of that product. And so what I wanna do is, I've got other videos that go through the regulatory history and all that stuff. What I wanna do in this video is give a summary as to why I built my hypothesis of the fact that life insurance companies ultimately shifted into the IUL space because they needed to shift the risk from them meeting all the guarantees to having and having no control, and the policyholder having the control like they have in a whole life policy, to selling Index Universal Life where the life insurance company has all the control and the policyholder has very, very little control. And so I think it all starts, and we have to go back, like I said, into history, and we look at 1997, Index Universal Life was created. Okay, that's fine. So a lot of people look at this, and actually what I'm going to do here is I'm going to go to my board because I think this is really funny. This is really an interesting exercise. So if we look at this and we build a timeline, so 1997, IUL created. Okay, so that was that. And then we looked at this, but it was only one company, right? It was one company. And so then the market was ultimately created. So then the question is, what? A lot of people look at it and they go, oh, well, and David McKnight just did this video on me talking about how I had to be wrong. This hypothesis had to be wrong because of the fact that MassMutual, Guardian, companies like that aren't selling Index Universal Life. New York Life aren't selling Index Universal Life. So my hypothesis had to be wrong. Well, this is what I want to show you. So by 1997, one company done it, but look at this. These are all, a lot of the big players, not all of them, but by 2011, there were 14 companies selling it. I think it's important to show, and I did this in the other video here. I'll go over to this slide right here. I think it's important to see that it was 2009 here, 2009 right down here, when they picked up like 6% market share. And this is a LIMRA study, okay? And so they literally had no market share back in the day, right? Like virtually no market share. And so it was a budding market and they were trying to figure things out. So it was created here, but it was one company that was like inconsequential in the market. By 2011, they still had very minimal market share. It was starting to pick up in 2009, right? And that is what it is. But now let's go back and let's say, okay, how was the IUL industry built? Like, what were the companies that built it? Why did they build it? And how has it, over the past decade, from 2011 to 2023, how has it dominated and become one of the top selling insurance products in the world, right? So now let's go back here and let's just take a look at this. I think this is really, really, really vital for people to understand. 1999, John Hancock jumped in the arena. What did they do? They demutualized. Prudential, 2001, demutualized. Minnesota Life 2005 demutualized. Now Minnesota Life was a huge player in the IUL space back then. They still sell it. They were a monstrous player back then. MetLife demutualized. Principal Life demutualized. Companies like National Life, Pac Life, and Penn Mutual demutualized, right? These are 1, 2, 3, 4, 5, 6, 7, 8 of the 14 companies in 2011 were whole life companies that either demutualized or kept remaining a mutual company, but they utilized IULs and they shifted it, the risk, they basically started selling more as a way to shift risk from the insurance company to the policyholder. And so when you look at it and you see that and you go, wow, okay, this is starting to make a lot of sense. And you go, wow, why would they do this? It's because the actuaries, and by the way, I started digging into this hypothesis because of a conversation that I had with an actuary on why a company had started selling IUL, even though they had 140 years history of being a top-notch whole life company. And the answer was, well, Chris, the fixed rate environment has gotten really bad. It's putting a lot of stress on the general fund of the life insurance company, and so they have to create other streams of revenue, A, that are going to support it, and B, they don't want to keep selling new blocks of business in the whole life space because there's too much risk on the general fund by meeting those guarantees. And so therefore they started selling more index universal life, because in index universal life, the insurance company has the control, they get to move all the levers, and ultimately it's a more profitable product over the lifetime of the policy. And so when you look at it like that, it's like, all right, it makes sense. So then it forced me to take a deeper dive, and I started looking into companies like, are they the only company doing it? It's probably not the case. What's going on? So that's when I came to this conclusion. I started looking around and I was like, all right, we got these 8 companies right here, right? That have all basically done the same thing, right? And so, you know, if you look at this, it's actually kind of freaky. They built this business 1999, 2001, 2005. These guys were in the mid 2000s as well when they started doing it. Pac Life, same deal. Penn Mutual, was I think late 2000s. MetLife, you can see they were all earlier adopters, and they all did this, and it was a big thing. Now, one of the things I want to jump ahead before I forget to do this, because I didn't take notes on it, but a big thing to understand here is it's another situation has reared its ugly head, and that's Ohio National, right? So March 11 of 2022, Ohio National demutualized. If you know Ohio National's story, they ran into some financial troubles with their general fund, the way they were managing different products. I'm not getting into the details of that. That's not the purpose of this video, because that'll be a total sidetrack. But the bottom line is they ran into issues. They ran into a situation where they had to demutualize, right? And so what are they doing now? If you go back and you look at Ohio National right now, one of their top products this year, even though they never sold it before, is an index universal life product. Why? Because they are just repeating the process that all these companies ran into for problems in 2001. Now, David McKnight said in his video trying to debunk my position, he said that it was the dot-com bubble, right, in 2000, 2001, 2, that caused the IUL market to expand. Well, no, it was the dropping rate environment that caused these companies to have too much stress. And there's a difference, I should say. There's a difference between what built the market and what popularized the market. These companies got into the IUL market because they needed to, because financially they were desperate and their financial books were having problems. So they had to go demutualize to kind of fix their books. And that is ultimately what happened in this time frame window. The fact is, in 2009, obviously the story after the Great Recession was upside potential, downside protection, how these things were sold on. And that absolutely depopularized the market, and that got them up to about a 6% market share for IULs for cash value life insurance policies, and that has since grown in the graphic like that I just showed before. And so that, this happens, and this is the history. You can see, these companies that all joined this area, that joined that space and shifted their product base because they needed to from a profitability perspective and to meet the guarantees. Both of those things combined of the previous obligations that they had of the products that they had sold. And so then 2009 comes around, and that's what made the market share take off, because now we had some companies selling it, and now the story was compelling. And they basically, this is where the massive misrepresentation of IUL really started kicking in, right? And this is why I created the IUL challenge, the hashtag IUL challenge, right? And the bottom line is, when we look at the IUL challenge, this is saying, hey, over the past decade, we've had the greatest bull run in the history of the market, yet policies have still underperformed their promises, right? If these illustrations are so-called conservative illustrations, and there's upside potential and downside protection, if you're not getting upside in the greatest bull run in the history of the market compared to a conservative illustration, well, then what the heck are you doing? That's my problem with them. And I've had some people say, Chris, I'll take the IUL challenge if you take the whole life challenge. The answer is, guess what? Whole life policies have underperformed their illustrated rates as well. I have no problem having that conversation, because if you understand functionally wise, how whole life policies perform and why they perform, it's because it's directly related to the fixed rate environment. The same reason that these guys were struggling, right? If interest rates, in 2011, if interest rates were, if interest rates, let's just say 6%, okay, and then dividends were going down, and from 2011 to, and this is 2011 to 2020, let's just say, or 2022, interest rates went down to 2%, let's just say, which is kind of what they did for mortgage rates. They got into the 2.5% range, right? And if they did that, well, this gap right here, right? This gap creates stress on the life insurance companies. And, this is, this forces, I should say, dividends to go down, because the fixed market, this gap right here, is ultimately what the life insurance companies utilize to create a dividend rate over the long haul. Now, as this rate is going up, which it's already starting to go up, we're already in the 6% range again, the dividend rate is going to lag a little bit. It's going to take a little time. It's going to trail and go up with it. Well, whole life policies will get better. Along the while, IUL policies, as dividends go up, are not going to get better. And I've done a lot of videos on why that's the case. But kind of getting back to the point here, I think it's important from a historical perspective to understand, when you understand, fundamentally speaking, why the IUL market was built and how it grew in the first place, just in a vacuum, around these companies basically trying to rescue themselves, these companies trying to save themselves and save their general funds and save their current policyholders and not have to sell out completely and do all these things. This is what I'm talking about. And so the latest casualty is Ohio National. There's no secrets about that. There's a lot of to do and talk about that over the past year, because that obviously happened less than a year ago. And so when we look at this, though, I think it's really important to differentiate and to distinguish the difference between why was the market built and how was it built, what companies did it, and then what happened was in 2011-ish, companies started seeing, ooh, this product is getting market share. Ooh, this product is extremely profitable. So what company, whether it's stock or mutual, for a lot of companies, now a lot of mutual companies refuse to still sell IULs, like Mass Mutual and Guardian and One America and New York Life and Lafayette. These companies, they refuse to sell IUL because of the fact that it's not in alignment with their core values as a company. And so that's why I love these companies, right? Because they do these things the right way. And so when you look at, though, in 2011, of course, if these companies are seeing an opportunity and they're looking at whole life and the dividend rates and like the general funds and the way it all works, and there's not as much profitability there, of course they're going to shift their attention and build an industry and sell a product that ultimately is a much more profitable product that the insurance company controls the moving levers to mitigate their risks, right? That's what it's all about. That is what ultimately has built the industry. Now, why were they built on more sales? Yeah, they were built on more sales were created in 2009 because of the fact that, the Great Recession happened, and the story of upside potential and downside protection absolutely exists. But this is why I always tell people, Index Universal Life, it's not that I hate the product, because IUL as a permanent cash value policy, while I would still choose whole life personally, if somebody came to me and said, hey, Chris, I want to get a life insurance policy, I need it to be in place forever, I'm going to overfund it. If you overfund an IUL, like way overfund it right to the MEC limit, and you have it for purposes of permanent death benefit, it can work. I still think whole life's a better vehicle, but it could work. There's not that much risk in it. But when you start utilizing it as a tax-free retirement income vehicle, that's where the risks start to go through the roof. That's why I always say Index Universal Life is the most misrepresented financial product on the face of the earth, because people try to position it as this rich man's Roth, 401k alternative, things like that. And when you look at it and you understand it and you look at the numbers, you realize that nothing could be further from the truth. That's why regulations are getting updated right now. Illustrated incomes on a lot of these engineered index products like Allianz, like the Nationwide products, they're all going to get impacted. Symetra has a product like that. They're all going to get impacted extremely negatively by reducing their illustrated income by up to 50%. Now, everybody that's bought them to this point in time, what does that mean for you? That means if you've bought a policy since 2020 when Regulation AG 49A came out to today, it means whatever you saw for illustrated income, if you bought it for income on your illustration with an engineered index, it means it's not going to perform anywhere close to what was shown to you, so you need to understand that. And so anyway, that is what I got. IUL, most misrepresented product on the face of the earth when it comes to the financial industry. This is kind of why I wanted to do this video, just really honing in on the foundation of how companies started, what companies that started the industry were, and it's not something that can be looked past, in my opinion, about how important it is that these are the companies that built the industry. Now, they're not all leaders in the space anymore. A lot of them have been surpassed. A lot of them still sell. Most of them still sell IUL. They're just not, at the head of the pack. Companies like Allianz and Nationwide and National Life Group, they're still right up at the top of the list there. Pac Life still, they're still up there, but there's a lot more competition now, right? And so the whole environment is completely changed. But I think what I see a lot is there's these agents that have been in the space for 2, 3, 4, 5 years, and they don't understand the history. They haven't taken the time to go through and really understand, like, how was this market built? And I think, like anything else, you need to understand that from a fundamental perspective if you're going to put your money into anything. So if you have any questions, any comments, comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. Hopefully you found value in this one. If you did, please like it, share it, all that stuff. And that's it. Have a blessed, inspirational day. We'll talk soon.